All right, we will move on to number 15, the CAFR.
Good evening again. In November, I provided City Council with a very detailed financial report. Those were based upon pre-audited numbers, and I'm pleased to say that after the completion of the audit, the auditors did not have any adjustments whatsoever to the city's major operating funds, which is our general fund, our water, and our wastewater operating funds. This is the third year that the firm of Badawi and Associates has conducted the city's annual independent audit. The audit goes out to bid every 5 years, and we like to get a fresh perspective and a fresh set of eyes in reviewing the city's financial statements and our internal controls. The comprehensive annual financial report presented to you this evening contains an unqualified opinion, meaning that our financial statements are fairly presented. This is the best or highest opinion that a city can receive. There were no areas identified in the single audit report where they had recommendations. And there were also no prior year recommendations, so therefore there was no follow-up providing a status of the prior year recommendations. City staff implemented the recommendations that were made in their first year audit. What this means from city staff's perspective is that we have a very clean audit. Our internal controls are functioning as we would anticipate and expect. And with that, I would like to introduce Mitesh Desai from Badawi and Associates to give you an overview. Excuse me, Trish, can you pull up the next presentation, please? Just a moment, please. Sorry about that.
It's all over with you and Rosa.
Yes. Got it. Perfect.
All right. Thank you, Robin. Thank you, Mayor, council members. So I have a short presentation here. I know that was a lot of financial information already covered. I do have some financial slides, so I'll try not to be redundant, maybe just focus on some highlights. To get started, so we've completed our audit of the 2019 financial statements. Our agenda will go over the engagement team, deliverables, some areas of primary emphasis. We do audit the complete financial statements, but pay attention to certain areas more than other areas. It's a risk-based audit. We'll go over the auditor's reports. I think Robin already mentioned it's an unmodified opinion. And go some financial trends, required communications. We'll briefly talk on new accounting standards that are coming the city's way, and I'll leave some time for questions if needed. So Ahmed Badawi was the engagement partner, so he was responsible for the entire audit. I was the manager on the audit, overseeing the team. We had one senior, his name was Salah, and one staff, Fedor. We have a quality control reviewer. They're not necessarily part of the engagement team, but they perform a quality control check on our work papers and the report to make sure we followed auditing standards and we didn't miss anything on our side. We do have access to an IT specialist. If there was any specific risks that we identified in the city's IT, they would be involved in the audit. Normally when you have off-the-shelf software, we don't normally involve them, but we did have access to him if needed. Our deliverables included the independent auditor's report, a report on internal control, a single audit report or a report on compliance and internal control for compliance with major federal awards, a GAN limit, which is agreed upon procedures report, and we'll be issuing a letter pretty much briefly going over what we'll be talking about today, which is our communications with those charged with governance. Areas of primary emphasis. So as I mentioned, we do look at everything, but we look at certain things more closely than others. That's by identifying risks. So as part of an audit, we are required to look at revenues more closely. We have to assume a risk of improper revenue recognition, either for trying to for management bias or for trying to make budget or other reasons. So we do more procedures on revenues, and that includes confirming revenues. So we do run reports from the CDTFA. It's a new department, but we compare those sales tax reports to what's the city recorded. We obtain a confirmation from the county, validate the sales tax. We get other reports for gas tax and SB1 monies and confirm those. We do analytics on proprietary revenues for water and sewer. We compare your revenue trends month to month to consumption, to other indicators. For pension and OPEB, those are relatively new accounting standards, so we consider them to be complex in nature. So we do look at those journal entries more closely. We get auditors' reports from PARS and also from CalPERS and compare those audited reports to what's in your actual evaluations and what's recorded on the financial statements. And management override of internal controls is another assumed risk. It's not anything specific to the city's audit. It's a risk that exists in all audits, that management are the people who put controls in place, so they have the authority to bypass those controls. So we do procedures. We look at manual journal entries. We examine estimates. We scan the general ledger for any unusual items to just, address that risk when we're performing the audit. So the auditor's report, so we issued an unmodified opinion. What that means is that your financial statements are fairly stated in all material respects. Disclosures are complete and adequately disclosed. Estimates are reasonable. We had one board member that wasn't happy with the word fairly stated. They felt that it's an A- and not an A+. Unfortunately, that's the language we're allowed to use as part of auditing standards. And the reason why is that we don't look at everything. We don't validate 100% of your transactions. We use sampling. We look at we have materiality thresholds. So as far as we're concerned, financial statements are fairly stated in all material respects. There may be errors. However, those errors are immaterial, if any at all. Going over some financial trends, I'll speed through these. This is just a 3-year trend of your assets and deferred outflows. Nothing too significant here. You'll see there was an increase in your capital assets, and that's mainly due to the bridge project, that you had some significant expenditures that were funded by Caltrans this year, last year. You did have an increase in long-term debt that was due to a new debt that was issued in the, I believe, the water fund this year. No other significant changes. Your net investment in capital assets went up, mainly because of the bridge project there. No other significant changes. You'll see this slide on slide number 13 is your trend of change in net position. This year, it's a bit of an anomaly that it seems like as though you have a big jump in revenues and you have a big change in net position. And the reason why you see it this way is that you did have a lot of capital grant revenues from Caltrans, for which the revenues are recognized on the income statement. However, the expenses or the expenditures that you paid for or that the grant funded are being capitalized as to capital assets. So there's no related expense there. But you do that; those expenses eventually will be, written off as part of depreciation expense. So you'll see that in future years. I just want to explain that it's not you have some brand new revenues in light of what the previous presentation. And similarly here, you'll see that your net cost of service decreased, and the net cost of service, pretty much the net cost of service is meant to represent your cost of service, so your expenses for different government functions, police, fire, community development, etc., offset by any revenues that those departments generate. So, for example, the police department generates, police fines or tickets, or you charge for permits. Those are offsetting to the expense. Those expenses are not. You don't normally charge exactly what those expenses are. So you would always have a net cost. That net cost is supposed to be funded by taxes and other general revenues. So normally you would expect that your taxes would cover the net cost of service. Again, this year it's a bit of an anomaly that it looks like your net cost of service significantly decreased. That's because those capital grant revenues from Caltrans need to be included as part of program revenues, which decreases your net cost. I apologize. I probably should have taken this out or footnoted it or adjusted it to make it a bit more comparable, but it's really difficult sometimes. This is just a general fund expenditure coverage chart. Pretty much going over what was mentioned before. The GFOA recommends that your unrestricted revenues, the revenues that City Council has control over, be about 2 months of your expenditures. So in the unlikely situation that you stop receiving any further revenues, how long would you be able to operate? So you're about in the ballpark of two months. So that's pretty much in line with what they're recommending. Pension contributions. So yeah, pension contributions are growing as CalPERS increases those required contribution rates. This year, your miscellaneous contributions increased also because of voluntary additional contribution that was made for the miscellaneous plan of $750,000, I believe. So that's why your miscellaneous contributions were higher than safety, which normally would be more significant. This is a trend of your funded status for net pension liability. This is consistent with prior years. For the safety plan is the city participates in a cost-sharing plan, so it's not necessarily an exact figure. You're pretty much picking a piece of the total plan based on allocation factors that are based on others in the plan, and so it's not necessarily the most accurate number, but it's as close as you'll get. So there was no significant change in this year. With your miscellaneous plan, you did have a decrease this year, mainly because of higher assets or fiduciary net position in the plan. And that's based on investment earnings, employer contributions, benefit payments. So this year, or in the 2018 measurement period, you did have a $5 million increase in those plan assets that offset about the same liability, which resulted in a lower net pension liability. But that can change as investments and such change. So in your financial statements or the notes to the financial statements, there's a disclosure for pension and OPEB called sensitivity disclosures. And this is to highlight a very significant assumption that is used to derive your net pension liability, which is the discount rate. For 2018 measurement period, a 7.15% discount rate was used. However, it's a bit of an estimate. So GASB requires that you disclose what would have been the number had the discount rate been 1% higher or 1% lower. So you can see that had the actuary used a 1% lower discount rate, the liability would be double about. And if the actuary used the 1% higher discount rate, then you would have half the liability. So it's just a range. It just gives you an idea of what the number could be in the future, or some more information. On slide number 20, this is just a trend of your OPEB contributions for healthcare, retiree healthcare, and this has been consistently growing as well. With regards to your OPEB funded status, It's been consistent, slightly lower this year as you fund that plan. The actuary uses a lower discount rate, and you get a lower number at the end of the day, which is good. Similarly, you have a sensitivity disclosure for OPEB. You'll see the numbers or the swing is not as drastic as it is for pension, and that's just because you're looking at a health premium payment versus an annual pension salary in terms of the number that's being projected in the future. Someone's retiree health premium is smaller than their annual pension, so that number is not going to swing that much due to the discount rate. Also, the OPEB plan is limited to certain employees versus the pension plan covers majority of the city's employees except part-time and temps. An additional sensitivity disclosure for OPEB, which needs to be disclosed, is the healthcare cost trend rate sensitivity disclosure. And this is another assumption that the actuary uses when it comes to OPEB is they assume, or they make an assumption as to how much healthcare costs will increase in the future. So similarly, if they assume that those costs would increase higher in the future, the liability to be higher. If they assume that healthcare costs will gradually increase, then that liability will be smaller. So this is give you an idea of that change or what the number could be. Just going over some required communications that we're required to make as part of the audit to you is our responsibilities versus management's responsibilities. It can be confusing, or it can be a bit, confusing when it comes to the financial statements and the auditor's reports. They're all together in one document. It's not our document as the auditors. It's management's document. Our documents are the 2-3 pages that are in the beginning of the report, which is the auditor's opinion. So in terms of our responsibilities as the auditor, we're responsible to opine on those financial statements as to whether they're fairly stated, evaluate internal controls over financial reporting, evaluate compliance, whether management complied materially with all laws and regulations, make sure that financials are transparent and disclosures are complete, and also to communicate with you as to the audit results. Management is responsible for everything else. They're responsible for the financial statements, establishing internal controls over compliance, detecting fraud, informing us of all known and suspected fraud, and also to comply with laws and regulations, and also to take corrective action if we do identify internal control issues or audit findings. Our responsibility is also to maintain independence. So it's crucial that we place safeguards, especially when we're assisting with preparing the financial statements, that we don't impair our independence, that we're auditing our own work or taking on management's role when we're preparing the document. So we do provide management with our account roll-ups, our journal entries. We provide them with any updates of new accounting pronouncements and what that requires. And we also submit our report once it's prepared to our independent reviewer, who we had on the engagement team, who hasn't looked at the document at all, to provide their, third eye on it, to make sure that we're not making any biased or independent violations. In terms of timing of the audit was, we're here, so we're presenting the audit before December 31st, so it was performed timely in accordance with what we agreed on. Significant accounting policies and unusual transactions. So there was 2 new accounting pronouncements that were implemented this year. GASB 83 discusses asset retirement obligations. That did not apply to the city. And secondly was GASB 88, which adjusted your footnote for debt, long-term debt. So you'll notice this year that your long-term debt disclosure looks a bit different. Pretty much it just requires a segregation of publicly issued debt versus private debt or private placement debt. So any bonds that were, went through a public offering would be grouped one way, and any debt that went through direct financing with one lender, that would be grouped as a separate debt. So the city does have a couple of those, so those are segregated and disclosed in the financials. Some significant estimates that are in your financial statements are the OPEB numbers, the pension figures, investments, and also the useful life of capital assets. Sensitive disclosures in the financial statements, so there are quite a few of them. So some highlights are the footnote 1, cash investments, that provides more information about your investments, your maturities, credit ratings, the investment policy. Long-term debt is a very significant note. And also your pension and OPEB note are quite lengthy and have a lot of information as to what the assumptions were that went into the numbers and the sensitivity disclosure and such. We're happy to report there were no difficulties encountered during the audit. And there were just some reclassifying entries that we proposed, that management has posted all entries. None of them were for the operating fund, of course. No significant risk or exposures that need to be disclosed in the notes. No disagreements with management. We did not identify any material weaknesses that need to be disclosed to you. We obtained a representation letter from management before we issued our report. Representation letter pretty much states that management is responsible for the financial statements. They have provided us with all information that we need to know about before we issue our report. Anything that was provided to us is valid and accurate as far as they're aware. We are not aware of any third-party consultations. Sometimes if we have a disagreement with management may seek a third opinion or independent opinion to get validation of what we're proposing. We're not aware that management has made any such consultations. No other written communications with management other than the engagement letter and representation letter. There were no material uncertainties regarding, that's a going concern paragraph that we need to disclose to you, where we believe that the city will not be in existence within 1 year from our issuance of the report, so that's a good sign. We're not aware of any fraud or illegal acts that we need to disclose to you. Following are just the new accounting standards that are coming your way. So the big one that would impact the city are probably fiduciary activities, since the city does have a lot of agency funds and also has the trust fund with PARs for pension and OPEB. So those may need to be reviewed this year just to make sure that they're following the new accounting pronouncements for fiduciary activities. And in 2021, there's a disclosure that talks about leases. So the lease accounting is changing in 2021. So that would be something that we'll work with management if we're here to implement. Just a good joke about potholes, since it's being discussed. Where I'm from, we have some potholes that we call bath holes, and people literally take baths in them sometimes. So, but with that, I'd like to just leave my email address and also Ahmed's email address if you want to contact him directly, since he's the partner on the audit. But I'm happy to answer any questions now if needed. Robin can answer as well, I guess.
All right, would anybody, member of the public, care to comment on the presentation? No, well, thank you very much. Clearly a lot of work went into that. Thank you so much.
A lot does go into it,
Yes.
and kind of a lengthy presentation, but that's a summation of all the work, which it's a pretty thick document. So thank you, council.
Thank you.
Robin, congratulations.
Thank you.
All right. Number 16, consideration of the Dollar General Development Project, which includes a couple items here.
Through the mayor.
Yes, sir.
Before we get started, does the council desire to accept the CAFR for
Forgive me.
15?
Through the mayor,
Yes.
I move to accept the CAFR and related audit reports for fiscal year ended June 30, 2019.
All right.
Second.
Thank you very much, and thank you very much. All those in favor?
Aye.
And opposed? None. Thank you. Thank you, sir.